primary message from the jobs report is that the expansion continues. Remember all that fear of a double-dip recession? Absolutely not. When you're adding jobs and when you have the jobless rate fall to the lowest reading during this recovery, there's no new recession in front of you. So all of those fears that we were hearing in the headlines were very misplaced just a few months ago. Also, this report is telling us that a revival, like an acceleration of jobs growth, is not yet here. That's still in front of us. And I think we're going to have to wait a couple of more months. There was some hope going into the report by some people that we would get a big blowout number. Not yet. We're going to have to wait a couple more months probably. In English, what's going on, there's a lot of big sectors to the U.S. economy. There's basically manufacturing, services, and construction. And so manufacturing, starting to add a couple of jobs. Problem is, only 1 out of 10 people work there. 9 out of 10 people work in services or construction. Those haven't kicked in yet. We're getting temporary services jobs, but we're not getting the full-time employment jobs just yet. That's still, I think, a couple of months away. If you want to step back and look at it from a cyclical perspective, we came out of the recession in the middle of 2009, and it was a rebound, but we were in so much pain we didn't even feel the rebound. So then we're throttling back, slowing a bit in 2010, which is kind of normal. It happens in every recovery. But it scared everybody, so they got into this double dip mentality. Here, what you're seeing is clear evidence that there is no double dip. It's just a throttling back, and then we're going to re-accelerate, hopefully to a decent cruising altitude for a long flight. Okay, we can't predict that far ahead, but we certainly see that for the first half of 2011, we're going to get some revival and growth, some levitation in the economy that's going to include a firmer jobs market. And the reason that's really important is not only for people who are looking for a job, but everybody who has a job. Psychologically, they have permission to not be so scared. The Fed is not that aware of some basic business cycle dynamics. In the fall of 2009 and in the spring of 2010, they were talking about exit strategy, taking off the stimulus. And this is at a time when unemployment was high, and the so-called output gap, this technical term, was very large. And today, they're talking about adding all of this stimulus, right? $600 billion is being put onto the economy in terms of quantitative easing, easy money. And the justification is that unemployment is high and that the output gap is big. So it's kind of they're using the logic isn't holding up very well. The business cycle dynamics, these leading indicators, they are telling us that a revival is baked in the cake. The Fed and other stimulus is adding icing to that cake, but the cake was already baked. And so we'll probably get a little bit stronger recovery as a result. But you have to be careful. Sounds good, right? A cake with icing sounds good. However, a boom is followed by a bust. You always have to give it back at some point. And so we might get a little more volatility than we bargained for. But in the near term, it's going to feel good. The wind's going to be at your back.